This week's top 7 trades isn't just about DR Basics, it's packed with pro tips. Discover how to use the tick grid indicator to lock in more profits, leverage open volume imbalances to your advantage, and make smarter trades with historical data insights. Let's jump right in. Number 7. US dollar versus the Canadian dollar, Monday's overnight DR session trade. What do we have here? It's the same model we discussed in previous top 7 episodes, repeating once again, this time in the US dollar versus the Canadian dollar. The relationship between the ADR and ODR points toward a DR downside model intact, in line with the green DR box and long confirmation from the overnight DR session. We will need to be selective with targets, given that aftermarket DR session levels may act as barriers for price in a DR downside model. What's important to notice here is that the ADR lows have already been violated by the confirmation candle. Looking to the left, there are no previous DR session levels aligning here, so we continue waiting for a retracement back into the DR and clear entry signals. Now, what about these rejections from the opening price? They're hard to ignore. This presents a potential 3R trade setup with stops below the DR mid, targeting the ADR mid levels. Remember, these levels can be sensitive since the DR downside model is still intact. Price drops lower and stops out this first position, a -1R on this one. But now it gets even better because price reaches the retirement setup area, giving you a second bullet for the session. With probabilities still on your side, this presents another opportunity for a potential 3R trade. And here we go. Price not only reaches the target, but violates all 3 ADR levels. This trading pattern strikes again. Coincidence? I'll leave that up to you. Number 6, light crude oil futures, Tuesday's overnight DR session with historical data from QuantX. Let's break down Tuesday's overnight DR session on light crude oil futures with some help from historical data in QuantX. Crude oil started the Tuesday DR intraday cycle with the aftermarket DR session inside the previous day's regular DR session, hinting at a DR range contraction model. The ADR saw a large sell-off, taking out the previous day's regular DR session lows just before the overnight DR session started, with the initial squeeze likely occurring there. The overnight DR session found strong support from the previous day's regular DR session lows and confirmed longs with the 4:30 a.m. candle. Looking to the left, there aren't any previous DR levels aligning here except one already highlighted, but there are several previous WIBs lining up and one open magnetic WIB just below the 1.5 standard deviation extension, a level of interest as it sits right above the previous day's regular DR session high. Now let's check the QuantX database with over 120 million data points to identify high probability retracement and target levels based on time and price. Focusing on Tuesday's long confirmations at 4:30 a.m., we're working with 41 historical datasets from the last 16 years. First, we pinpoint the times when most retracements historically happened, between 4:45 and 5 a.m., with 5:15 a.m. marking the 50% retracement point and 6:15 a.m. indicating 70% completion of retracements. Our goal is to find entries between the highest probability retracement time up until the median time, so let's narrow down to that specific time window. Now that the data is set to that time window, we look for high probability retracement areas. Most retracements happened in the -0.1 to -0.2 range, with a cutoff after -0.3, making it our high probability retracement area. For targets, historical data shows that the 1.2 to 1.3 SD extension was reached 76.5% of the time, and 1.6 SD was hit 70% of the time when the session held true. Back to the chart, you'll see a red line marking the time when 50% of retracements historically occurred, a darker line where 70% of retracements already happened, and a red box highlighting our high probability retracement area based on time and price, with a 1.6 standard deviation target reached 70% historically. As price retraces, it doesn't reach the high probability box within the time window, and 50% of retracements should be over by now if the session holds true. so no trades are taken yet. But just a few minutes later, with the 5:40 a.m. candle, price retraces into the minus 0.1 retracement area for the first time. Switching back to QuantX, we see that retracement and target areas remain the same if we include the 5:40 a.m. time. With almost 60% of retracements now complete, historical data suggests the session's high probability areas are still valid. With the retracement area intact and your stop loss below it, aligned with previous WIBs, a potential 6.6 R trade is in play here. This shows the power of historical data insights. You can see exactly what has happened under the same criteria over years of data, providing a decisive edge in your trading. Join me as I teach thousands of students how to trade like a professional. Learn how to trade the DR trading strategy combined with data, get access to exclusive tools and indicators, weekly live trading sessions where you also get deep market insights, which have never been taught in the retail space before, and a lot more. Visit m7dr.com for more information. Number 5, Russell 2000 Futures, Thursday's regular DR session trade. The regular DR session formed and closed as a red DR box with a short confirmation immediately after. Looking at all 3 DR sessions, we can see that a DR downside model is intact, supporting further downside potential. When we highlight the daily gap imbalance and intraday gap imbalances aligning with the defining range, it becomes clear where the downside expansion originated. In terms of volume imbalances, they also played a significant role in pushing price lower. The next step is to highlight previous DR levels from the week that align with the current range. These levels are crucial since they're highly relevant for market algorithms and can be helpful in decision making. The defining range is now heavily clustered, so we will remove the upper levels and turn them on only when needed, in case price retraces deeper into the range. Preparation for the whole session is essential here. Now look closely what else stands out in the first hour of the regular DR session's price action. We have 2 open magnetic volume imbalances inside the range, one located at the lows and the other near the top. Remember, open volume imbalances act like magnets, and price often returns to rebalance them at some point in the future. As price drops lower, it creates additional WIBs, adding even more confluence for an expected retracement. Price makes its way back into the defining range, rebalancing the lower volume imbalances and rejecting the closing price in line with some previous DR levels. Notice that darker area where 2 previous DR sessions overlap, that's a strong confluence zone. This is your potential entry right here, with stops above critical areas and targeting the next standard deviation level of 1. Watch those further rejections from key levels as price makes its way to the target. These were multiple opportunities to enter with an even better risk to reward. Number 4, Euro versus the Australian dollar, Monday's overnight DR session trade. In the Monday's overnight DR session on the Euro versus the Australian dollar, we started with a green DR box and an immediate long confirmation. Looking at the relationship between the aftermarket and overnight DR session, a DR upside model is intact, making the ADR highs an appealing target just above the 1 standard deviation level. When we look to the left, we don't see any previous DR session levels aligning with the current price action. Price consolidates and hovers around the DR highs for nearly 3 hours before finally showing some clear rejections from the defining range highs. Latest by the 5th rejection, it's time to take the trade. It doesn't get much clearer than this. Targeting the next standard deviation level of 1 offers more than 3R, making it a solid trade setup given these confluences. Unfortunately, price dips lower into the range, leading to a stop out on this first attempt. A bit later, price fails to close below the defining range mid-level and rejects the opening price as well. This presents a second potential entry for the session, with stops at the beginning of the retirement setup area. If this one fails, it's time to stop trading for the session. Now it gets interesting. We have multiple confluences aligning. A DR upside model intact, a green DR box with a long confirmation and rejections from the opening price and IDR mid. You can't ask for a better setup, can you? Almost at the end of the session, price reaches the next standard deviation level of 1 and continues the DR upside expansion model into the regular trading hours. What a beauty. Number 3, Nasdaq 100 Futures, Tuesday's regular DR session trade. Nasdaq kicked off with a familiar setup, starting the DR intraday cycle with the ADR and ODR relationship I've covered in previous videos, this time setting up a nice retirement trade in the short direction, targeting the aftermarket DR session lows. If you're not familiar with this trading pattern, make sure to check out the earlier top 7 videos. You won't want to miss it. With the regular DR session opening, Nasdaq traded lower and took out the aftermarket DR session lows before pushing higher to take out the overnight DR session highs. This classic trumpet-like price action plays both sides of the market, but without a guarantee of continued moves to both sides, we'll stick to DR Basics and select only the highest probability trades, if one is offered. We are starting with a green DR box and a long confirmation, so our focus here is on long setups. Looking back over the week's price action, several previous DR levels align with the current defining range. Above the next plus 0.5 standard deviation level, there's also a previous DR session high that might be interesting for upside targets. Returning to the current defining range, we will toggle off the lower DR levels for now, but keep them accessible if we need them. There are no intraday gap imbalances from either the aftermarket or overnight DR session, but we do have several volume imbalances that line up, which will provide extra confluences for a long trade setup. Now that we are prepared, let's wait for a potential entry. Price trades higher, closing above the previous day's RDR highs before retracing to its lower part again, with the candle closing precisely at this level. Even though there's a sensitive area below, with another previous DR session level and 2 volume imbalances, this presents a potential entry. By covering the IDR high, the volume imbalances, and previous DR levels with your stop loss, this setup offers a potential 3.7R targeting the previous DR session level. While the 1 standard deviation level is right above, it's smart not to be greedy here. 3.7R is more than enough. Just look at the next candle rejecting that key area. Another great entry opportunity. As price continues higher and starts rejecting the plus 0.5 SD extension, it's time to check the tick grid for an extra confluence to hold onto your position. I've made a video about this powerful tool. If you haven't seen it, it's free on my channel. What do we see here? Price is continuing higher while the tick grid reaches the lower extremes and shows a divergence in price versus tick. Finally, price hits the target and just before the end of the session reaches the plus 1 standard deviation extension. Beautiful price delivery right here. I highly suggest reverse engineering trades like this. There's no risk involved and the gain in knowledge is incredible. Over time, these characteristics will become second nature and easier to trade with real money on the line. Number 2. Light crude oil futures Wednesday's regular DR session trade. The session closed as a green DR box and confirmed longs with a higher probability by closing outside the range on a 5-minute time frame. When we look at all 3 DR sessions, we can see a DR upside model is intact, aligning with our bias for long setups. Some WIBs align with the current DR session. Looking further left, 2 previous DR session levels align with the current defining range, both closer to the retirement setup area. Returning to the current regular DR session, we wait patiently for a retracement and are prepared for any potential setup. Price moves aggressively away, taking out the ODR highs, exactly what we want to see in an upside expansion model across all 3 DR sessions, and extends more than 2 standard deviations during the session. With this move, price created an open magnetic WIB and rebalanced it as it retraced back into the defining range. Even though we see 2 clear rejections from the IDR high in line with the closing price, it's essential to manage expectations. With the ODR highs already taken out and price having extended beyond 2 standard deviations, aiming for the next SD level is unlikely for a high probability trade here. But let's look closer. There's a small yet critical detail here. 2 open magnetic WIBs can serve as confluence. Remember though that these don't always rebalance immediately. While they act as a magnet for price, they may be rebalanced later, even in future sessions. This setup offers a 3R trade with your stop loss covering key levels, including the opening price and WIBs. Price trades higher, rebalances the 2 highlighted open WIBs and extends a bit further. Here, setting your expectations realistically while maintaining a clear roadmap and stacking confluences leads to a profitable session. And here's number 1. Gold futures Thursday's overnight DR session trade. First things first, the relationship between the aftermarket and overnight DR session points to a DR downside model intact. With the short confirmation in the overnight DR session, we are looking to use these confluences to our advantage. This week's previous price action provides multiple previous DR session levels that not only align with the current defining range, but also serve as potential targets at the 1 and 1.5 standard deviation extension levels. In terms of intraday gap imbalances, there's just one above the range from the aftermarket DR session, along with several previous volume imbalances. However, for now, we will focus on those inside the current defining range. Below the current price action, there's also an open magnetic whip from the previous day's regular DR session, acting as another downside confluence. Now we wait for clear entry signals. A few minutes later, price retraces back into the defining range and shows it to the tick rejection from previous DR session levels, the opening price and whips. With these stacked confluences, the precise rejection makes it worth taking your first bullet here, with stops covering all the critical levels. To the tick rejections like these are not random, they are absolutely intentional. Price drops lower and hits the target. Look at these clean rejections, it's absolutely beautiful, but it's not over yet. We retrace deeper into the defining range, now sitting at the retirement setup area. Once again, we see an almost to the tick rejection from a previous DR level. Remember, we're still in a DR downside model and ideally want to avoid a false session. Even though the first trade was successful, price presents another great opportunity. With this deeper retracement, it left an open magnetic volume imbalance right at the plus 0.5 standard deviation level. Without even aiming for a new low, this retirement setup offers another potential 3R trade. And as the session finishes, price extends even further down. The more you focus on these details and prepare yourself before each session, the more you'll understand the puzzle. And we haven't even tapped into historical data or advanced tools here. Thank you for watching up until the end. Make sure to leave a like and I hope to see you in the next video. Have a good trading week.
We're gonna take on the world.